Usually, when we talk about a stock market index, there is this underlying expectation of, well, like broad safety.
Right, exactly. It acts as a shock absorber.
Yeah, you dip your toe into a massive fund, the waters are vast, and the different sectors balance each other out.
You buy a basket of 100 different companies and you figure you're insulated from the storm.
Exactly. The financial industry just points at it and says, there you go, you are officially diversified.
But then you step into the world of high-yield tech funds and covered call strategies.
And suddenly that calm ocean is more like a high-pressure fire hose. We are looking at a landscape of concentration and yield today that is genuinely intense.
It tosses out the traditional safety net in exchange for raw, concentrated financial firepower.
It really does. So welcome to another case study by Blueprint to Escape.
Glad to be diving into this one.
Today we are focusing on a highly specific mission for you. We are analyzing 5 U.S. technology Nasdaq ETFs to maximize growth and income.
And specifically looking at how this plays out inside tax-advantaged accounts, like an RRSP in Canada or a 401k in the U.S.
Which is a crucial distinction we will get into later. But our goal today is to uncover exactly why a newly launched ETF is suddenly beating the established heavyweights in the space.
Right.
Crucially, we are going to analyze the specific risk differences between broad tech exposure and highly concentrated semiconductor holdings.
Before we break down the mechanics of these specific funds, we really need to establish the necessary legal and financial guardrails for this analysis.
Yeah, definitely lay it on us.
So this case study is strictly for educational and entertainment purposes only. It does not constitute financial, tax, visa, personal, or investment advice.
Right. Always do your homework.
Exactly. You should always conduct your own thorough research and consult a licensed professional before putting your capital at risk. To be clear, any companies or ETFs we mention are not official sponsors of our content.
They are included solely as subjects of our research.
Yeah, and they may or may not be part of our personal portfolio at the time you were listening to this. Make sure any investment content discussed aligns with your personal financial goals and risk tolerance.
Makes sense.
Finally, the insights we are sharing are generated from original expert knowledge and independent research.
I'm glad we set those parameters because, wow, we are dealing with some aggressive financial machinery today. Let's set the table for you. In this case study, we are featuring 5 specific ETFs,
which are QQQ, XLK, XLKI, QQQI, and GPIQ.
Because you really cannot understand the danger or the appeal of the yield until you understand the engine generating it.
Yeah, the yield is merely the exhaust, right?
Precisely. The underlying index is the combustion engine doing the actual heavy lifting. If you don't know what is firing the cylinders, you are flying blind.
So before we can tackle the high-yield options, we absolutely must tear down the base indexes they are built upon.
Let's look at the baseline growth ETFs first. On one side, we have QQQ. This tracks the Nasdaq 100, carrying a 0.18% expense ratio.
And on the other side, we have XLK, tracking the technology select sector with an impressively low 0.08% expense ratio.
Our case study highlights a stark difference in concentration here. QQQ actually includes a significant amount of what we would call non-pure tech.
Right, which surprises people.
Oh, totally. We're talking about Amazon at 4.69%, Tesla at 3.52%, Walmart at 2.56%, and even Costco at 1.94%.
People hear the word Nasdaq and immediately assume it is an exclusive technology club.
But it's not.
Mechanically, no. The Nasdaq 100 simply tracks the 100 largest non-financial companies listed on the Nasdaq exchange, because it is market cap weighted.
The massive consumer retail giants get pulled in simply by virtue of their sheer size.
Exactly.
Okay, let's unpack this with an analogy. QQQ is essentially a massive superstore.
Okay, I like that.
It features a giant state-of-the-art electronics section, sure, but it still sells bulk groceries and household goods through Walmart and Costco.
Just to keep the revenue steady when people aren't buying new laptops.
Yes. XLK, on the other hand, is a highly specialized microchip boutique. XLK is roughly 98% pure tech.
So almost completely concentrated.
It has absolutely 0 non-pure tech holdings, and it is incredibly top-heavy. The top 5 holdings make up 46.5% of its total assets.
Wow.
Doesn't removing that retail buffer, like the Costco's and Walmart's, make XLK fundamentally riskier on a day-to-day basis?
Oh, absolutely. It redefines the entire concept of risk for this specific market window. You lose the shock absorption of a consumer staple.
Because a company like Costco tends to generate steady revenue, right?
Yeah, regardless of whether the Federal Reserve raises interest rates a quarter point or a global supply chain bottleneck hits silicon wafer production.
People still buy groceries.
Exactly. But looking at the performance data we pulled for this case study, shedding that stability is actually the primary driver of the outperformance.
Wait, really?
Yeah, what's fascinating here is that taking on that pure tech concentration led to a massive 6-month return of 33.84% for XLK.
Over 33% in just 6 months is staggering.
And in that exact same 6-month time frame, QQQ returned 19.53%.
Which is still great.
Nearly 20% in 6 months is historically phenomenal for a broad index, yet it is completely eclipsed by XLK.
So the lack of a buffer is exactly what drove the outperformance.
Yes. The lack of a retail buffer meant there was absolutely nothing to drag down the explosive momentum of the pure technology sector during that specific bull run. The anchor was lifted.
The very thing that makes it volatile is the exact thing that gave it rocket fuel.
Right. When the tech sector is running hot, holding shares of a grocery chain is technically a drag on your portfolio's velocity.
XLK essentially trims all the fat and leaves only the pure technological muscle.
But that muscle requires a very specific macroeconomic environment to thrive.
Because without the retail and automotive buffers, it feels every bump in the road much more intensely.
Which brings us to the core mechanism of the income strategy. Transitioning from purely accumulating value to extracting immediate cash flow completely changes the math.
Right, because since we established that XLK's pure tech focus is currently crushing the broader market, we need to look at what happens when you turn these engines into income generators.
By bolting on a covered call strategy.
The income-focused counterparts of these funds take those base indexes and turn them into yield machines. Built on the broad Nasdaq 100 engine, we have QQQI,
yielding an indicated 13.4 to 13.7% with a 0.68% expense ratio.
We also have GPIQ, yielding roughly 9.1 to 10.1%, but with a much leaner expense ratio of just 0.29%.
And then there's the new challenger.
Yes. Launched recently in July 2025, we have XLKI. This fund is built on the PureTech XLK index.
The yield on that one is wild.
It boasts a massive indicated yield of roughly 16.9%.
Yeah.
And it manages this with a lower expense ratio than QQQI, just 0.35%.
Pairing a near 17% yield with a highly competitive fee structure is a deliberate move to aggressively capture market share in the income investing community.
The short-term performance certainly grabs your attention. Over a 6-month period, XIKI returned 18.70%, easily beating QQQI's 12.86%.
It is taking that pure tech momentum we just discussed and actively translating it into a high-octane covered call structure.
But here's where it gets really interesting, and frankly, a bit of a trap if you aren't paying attention. Our analysis points out some critical tax differences between these funds.
Ah, right. The tax realities.
QQQI and GPIQ use something called Section 1256 contracts, offering a favorable 60-40 tax treatment.
That's 60% long-term, 40% short-term capital gains, regardless of how long the fund actually held the option contracts.
But XLKI does not qualify for this. Its distributions can be a messy mix of ordinary income, return of capital, and short-term capital gains.
Which completely changes how you hold it.
Wait, XLKI has a massive 16.9% yield, and it is half the cost of QQQI. But what's the catch with this tax setup?
It's a huge catch.
If you aren't holding this in a tax-advantaged account like an RRSP or 401k, doesn't ordinary income treatment create a massive tax drag?
It absolutely does. The tax drag can gut your real returns. Ordinary income is taxed to your marginal bracket.
So if you are a high earner, the IRS treats that 17% yield exactly the same as the salary from your day job.
Right. You could be losing 30 to 40% of that yield instantly to taxes.
That completely changes the math on the dashboard. You see 16.9%, but your actual take-home is a fraction of that.
The headline yield is always an illusion until you calculate the after-tax reality.
Which is why that Section 1256 treatment for QQQI and GPIQ is so important.
Exactly. While XLKI is the most aggressive income play, GPIQ actually offers the best balance for some.
A solid 9 to 10% yield, the lowest expense ratio of the group at 0.29%, and highly efficient tax treatment.
It avoids the extremes while optimizing for what you actually keep.
But that underscores exactly why the mission of this case study specified analyzing these funds inside an RSP or a 401k.
Because inside those specific accounts, the tax drag on ordinary income doesn't matter in the present moment.
Right. The shelter absorbs the inefficiency, letting XLKI's raw engine power run uninhibited. But let's pivot to the risk analysis.
Broad tech exposure versus concentrated semiconductors.
Because those explosive yields and returns of XLKI don't happen by accident. To really evaluate this case study, we have to look under the hood at the exact risk difference driving this outperformance.
Semiconductor concentration, the physical infrastructure of the modern digital economy.
Let's compare the specific weights of the top holdings. NVIDIA represents 13.55% of XLK. In QQQ, it is only 8.30%.
And Apple is 11.95% in XLK versus 7.32% in QQQ.
But the holding that really exposes the architecture is Micron Technology. It's the fourth largest holding in XLK at 6.59%.
While in QQQ, the fourth largest holding is Amazon.
Exactly. Micron is pushed all the way down to fifth place at 4.58%. Swapping a diversified global retailer like Amazon for a pure memory chip manufacturer like Micron
Completely alters the volatility profile of the fund.
You see it instantly reflected in the short-term velocity. The one-month return data shows XLK leaping ahead with a 21.01% return in a single month.
Compared to QQ2's 12.28%.
So what does this all mean for you? Are you comfortable having your passive income heavily reliant on a single subsector?
It's the big question to ask yourself.
I like to think of the Nasdaq 100 like a fully fleshed out sports team. You have a star quarterback, but you also have a massive, unglamorous defensive line made of Costco and Walmart.
If the passing game gets shut down, the defense can still keep you in the game. It's designed to weather different types of opponents.
XLKI is a team that literally just passes the ball to NVIDIA and Micron on every single play of the game.
It is breathtaking to watch when they're scoring on every drive.
But if the semiconductor industry pulls a hamstring, there is absolutely no defense on the field to stop the bleeding.
If we connect this to the bigger picture, a formal risk analysis based on the case study exposes how dangerous that lack of defense can be.
How so?
The broad tech exposure mitigates risk by spreading its capital across entirely different consumer behaviors. People purchase smartphones, buy bulk toilet paper, buy electric vehicles.
These behaviors operate on different economic cycles?
Exactly. If global demand for AI chips cools off tomorrow, consumers do not stop buying their weekly groceries.
The retail buffer kicks in.
But the concentrated semiconductor holdings in XLK and XLKI offer superior recent returns while carrying extreme vulnerability.
Because the semiconductor industry operates on massive boom and bust dynamics.
Yes. When companies decide to build dozens of new data centers, they order millions of chips. The foundries ramp up production, but building a new fabrication plant takes years.
By the time the new factories are finally built and pumping out chips, the massive tech companies have already finished building their data centers.
Suddenly, there is a massive oversupply of chips and no one buying them.
The supply glut hits, chip prices crash, and the stocks plummet.
And if the semiconductor sector faces a cyclical downturn, XLKI's aggressive yield and capital preservation could be severely tested compared to its broader peers.
The premium generated by selling the covered calls will dry up, and at the exact same time, the underlying asset value of the fund is contracting.
You lose the capital value of the stock, and your monthly yield gets slashed simultaneously.
Wow. Understanding the engine is non-negotiable. You aren't just buying a passive 16.9% yield.
You are buying a heavy, leveraged reliance on the perfection of the global semiconductor supply chain.
That reframing is essential for your personal life design and your portfolio choices. We want to ask the audience the exact questions from the case study.
Did you know about XLKI?
Like us, are you thinking about moving some money to XLKI that you might have otherwise invested in the more popular GPIQ and QQQI?
It poses a genuine strategic dilemma. Maximizing tax-sheltered yield versus protecting against cyclical hardware crashes.
Please post comments or questions down below, specifically letting us know your favorite income strategy.
We love hearing how you balance extreme risk and reward.
And urge you to subscribe for more content about financial independence, passive income, early retirement, and nomadic life design.
So you don't miss future breakdowns just like this.
As a quick note, we unveil our own portfolio once a month, right around the 20th, mid-month, to optimize for the next month's distributions. You can always find our current full portfolio down in the video description.
As we conclude, I want to leave you with a final thought to ponder. If a newly launched ETF like XLKI can immediately outperform established funds simply by concentrating heavily on semiconductors and covered calls,
what happens to this aggressive income strategy when the current semiconductor supercycle eventually cools down?
or consider the fragile geopolitical reality. The vast majority of the world's most advanced semiconductors are manufactured by a single company on the island of Taiwan.
Oh, wow, that's true.
If XLKI relies entirely on this hardware to generate its 16.9% yield, what happens if a geopolitical event in the Taiwan Strait disrupts that manufacturing bottleneck overnight?
The yield wouldn't just cool down, the underlying engine could seize entirely.
Exactly. It's the ultimate blind spot.
The yield might look irresistible right now, but you have to know exactly where the factory building your engine is located. Thanks for joining us for another case study by Blueprint to Escape. We will catch you next time.